Seanergy Maritime just dropped a record-breaking Q2 2026 earnings report. Net income hit $26.2 million, a massive swing from just $2.9 million in the prior year period. Net revenues came in at $55.7 million, up 59% year over year. Adjusted EPS landed at $1.32. For Q3 guidance, they're estimating a time charter equivalent, or TCE, rate of approximately $31,000 per day, with about 71% of available days already fixed. And immediately, our mission for this deep dive is to take this pure play Capesize earnings report and analyze exactly what it means for you, the retail investor.
Right, because looking past the headline numbers is really the only way to understand the mechanics here.
Exactly. We need to cut through the noise and walk through exactly how they achieve these massive margins, what management is signaling with, their massive fleet renewal, and the notable risks they are hedging against.
Yeah, for retail investors looking at the dry bulk space, this report provides a really clear view into capital allocation. It shows operational leverage during a very specific phase of the macroeconomic cycle.
It does. But before we get into the income statement, we should probably establish what Seanergy actually operates, right?
Oh, definitely. When we say pure play Capesize and Newcastlemax, we are talking about the absolute behemoths of the ocean.
Huge ships.
Right. Like vessels so large they cannot even fit through the Panama Canal. Historically, they had to sail all the way around the Cape of Good Hope or Cape Horn.
Which is where the name comes from.
Exactly. And they carry between 170,000 and 210,000 metric tons of cargo, primarily iron ore and coal, and increasingly bauxite.
And that operational leverage is really where we should start this analysis. I mean, the 59% revenue increase year over year is a strong top-line figure. But looking further down the income statement, that 59% bump translated into a 165% explosion in adjusted EBITDA,
reaching $41.5 million.
Okay, let's unpack this. Top-line growth, nearly tripling by the time it hits the bottom line, requires a very specific cost structure.
It all comes down to the daily unit economics of running these specific vessels. In the shipping industry, the core metric you want to look at is the time charter equivalent, or TCE.
Which is basically daily revenue, right?
Basically, yeah. It represents what the ship earns per day after subtracting voyage-specific expenses, so things like fuel and port charges.
Got it.
And in Q2, Seanergy's fleet achieved a TCE of $32,355 per day.
Wow. Compared to what, last year?
In the same quarter last year, that TCE was $19,807. So you have a 63% jump in their daily earning power.
That is a massive swing. But to understand the EBITDA increase, we really have to look at the other side of the ledger, which is the daily vessel operating expenses.
The fixed costs.
Right. The fixed costs to keep the ship on the water and compliant. Crew wages, insurance premiums, maintenance, lubricants, all of that. In Q2, Seanergy's daily operating expense actually dropped slightly.
Yeah, to $7,903 per day, down from $7,222 the previous year.
So the gap between that $7,103 airfreighting cost and the $32,355 revenue is where the massive margin expansion occurs. I tend to look at Seanergy's operating leverage like a high fixed cost factory.
That's a good way to frame it.
You have to pay the rent, run the machines, keep the lights on, regardless of how many units you sell. In Seanergy's case, their floating factory costs $7,103 a day to operate.
And once they cover that baseline, almost every extra dollar of that $32,000 plus TCE drops straight to the bottom line.
Exactly. The baseline is covered, so the rest is pure margin. But I have to ask, is this margin expansion purely luck of the macro environment, or is it a result of management's specific operational strategy?
What's fascinating here is that it's really the perfect storm of macro tailwinds meeting a disciplined, pure-play platform. Management attributes the strong market to record quarterly China iron ore imports.
Right, for their steel production.
Exactly. And we're also seeing this growing bauxite trade against a backdrop of really low fleet supply growth.
Yeah, management highlighted bauxite as a key demand driver.
Well, the global energy transition requires massive amounts of aluminum for EVs, solar panels, grid expansion, and bauxite is the precursor for all of that.
And crucially, a lot of this bauxite is moving from West Africa, like Guinea, all the way to China.
Which is a massive journey. It eats up what the industry calls ton miles.
Meaning the ships are occupied for way longer periods.
Exactly. Which effectively removes supply from the global fleet, pushing those daily rates even higher. But what's crucial is management's forward-looking strategy. They aren't just blindly riding the spot market.
No, they're hedging.
Right. They've already fixed about 55% of their ownership days for the second half of the year at about $30,800 a day.
Locking in those high margins?
Yes, but while preserving meaningful index-linked exposure. So if the Capesize market rates climb above that baseline, Seanergy still captures the incremental upside.
When a company is generating this kind of cash, the next question for retail investors is always, what are they doing with it? Seanergy is aggressively expanding, but with a highly specific timeline.
Right. The fleet renewal and growth program has expanded to a $591 million aggregate investment plan.
That is a huge number.
It covers 8 modern vessels, 7 new buildings, and 1 2022-built Capesize. A major Q2 highlight was agreeing to acquire 2 Japanese-built Capesize vessels for $130 million.
One is a scrubber-fitted new building, and the other is the 2022 built vessel, right?
Exactly. And just to clarify for anyone who doesn't track maritime engineering, a scrubber is basically an exhaust gas cleaning system.
Right. It lets them burn the cheaper fuel.
Yeah, heavier, high-sulfur fuel oil, which is way cheaper than the refined, low-sulfur fuel. The scrubber literally washes the sulfur out of the exhaust before it hits the atmosphere.
Bringing them into environmental compliance.
Right, and since these ships burn dozens of tons of fuel a day, that price spread, which can be hundreds of dollars per ton, goes straight to that TCE margin we were talking about earlier.
That is a massive competitive moat.
Yeah.
And both of these new ships are slated for delivery in 2029, right?
Yes, 2029. And simultaneously, they sold the older 2010-built MV Squire ship.
Which brought in some good cash.
Yeah, a gross price of $29.5 million. It generated $13.8 million in net liquidity and a $4.6 million gain. And they smartly kept the technical and management services for the vessel.
Here's where it gets really interesting, though. I need to push back critically on this timeline. Placing $130 million bets on ships delivering in 2029 seems incredibly far out.
It does sound like a long way off.
I mean, isn't locking in delivery slots 3 years from now a massive risk if the dry bulk market cycle turns? 3 years is an eternity in shipping.
If we connect this to the bigger picture, it makes a lot more sense. CEO Stantace Santanis specifically commented on securing scarce 2029 delivery slots.
Scarce being the key word.
Exactly. The broader global fleet is rapidly aging, and the order book is incredibly low. Shipyards in China, South Korea, and Japan are booked out for years, with high-margin orders for container ships and LNG carriers.
So there's just no physical capacity left to build these giant bulkers.
Right. Management is locking in modern, eco-design, fuel-efficient tonnage now to front-run an anticipated severe tightening in Capesize supply.
Because by the time 2029 rolls around, the older ships will be getting heavily penalized by new environmental regulations.
Exactly. Things like Phase 3 greenhouse gas reductions and Tier 3 emission standards. Older ships will literally have to sail slower to meet the carbon intensity limits, which artificially removes even more carrying capacity from the market.
But you mentioned risk earlier, and management seems acutely aware of the dangers of cyclical downturns. They are actively hedging both their new assets and their balance sheet.
To protect the company during this heavy construction phase, right?
Yes. Let's look at the charters. They secured long-term time charters for 3 of their 2027 Chinese-built new buildings.
And the structure of those charters is crucial. They have an average floor rate of about $23,100 per day, which is explicitly designed to cover their cash break thin.
So the floor guarantees the ships can service their own debt, even if the spot market totally collapses.
Yes, the floor ensures solvency, but they retain exposure to market strength. Above that $23,100 floor, Seanergy earns a premium over the BCI 180 index up to roughly $29,750 per day.
Right, the Baltic Capesize Index. And if rates push past that upper threshold, they share the incremental profits 50-50 with the charterer.
It's a very smart way to insulate the company during the initial years of the vessel's life.
For retail investors, you can compare these new building time charters to an options collar strategy. You cap your downside by covering break-even at 23.1K, but you keep a healthy chunk of the upside. You trade away a portion of the unlimited upside to guarantee you don't take catastrophic losses.
They are applying a sophisticated financial hedge directly to the physical ships.
But what about the debt? They just completed a €100 million 5-year unsecured corporate bond offering in Greece on the ATHEX.
Carrying a 4.90% coupon and maturing in 2031.
Does issuing a €100 million bond signal dangerous leverage? Or is this a calculated financial maneuver?
This raises an important question about their capital structure. The risk profile of debt is really dictated by the repayment schedule. And crucially, this bond utilizes a bullet structure.
Meaning no scheduled principal amortization before maturity in 2031, right?
Exactly. They just service the 4.90% interest. The entire principal balance is due at the end of the term.
So in a capital-intensive business like shipping, that bullet structure is highly strategic.
Oh, absolutely. By having zero principal amortization before 2031, Seanergy avoids draining its liquid cash reserve.
Right, because they don't want to be paying down debt while the ships are just sitting in a dry dock under construction.
Precisely. If they had a traditional amortizing loan, they'd be using cash generated by their current fleet to pay for ships that aren't even built yet.
Which would create a massive drag on their quarterly liquidity.
Exactly. So this is non-dilutive capital, perfectly matched to the timeline before the new vessels actually start generating revenue. They also secured a $60 million sale and leaseback agreement for a Q4 2027 vessel.
So they're pulling all the specialized financial levers to fund this expansion without risking current liquidity.
Yeah, they've built a very fortified capital stack.
So what does this all mean? Bringing all this operational leverage, fleet renewal, and risk mitigation back to the bottom line for the listener, it's really about shareholder returns.
Definitely. The board declared a quarterly cash dividend of 0.35 cents per share.
Which is their 19th consecutive quarterly distribution, by the way.
It is, and this represents a payout of approximately 27% of their Q2 adjusted EPS. So they are returning a quarter of their earnings and retaining the rest to fund that $591 million growth plan.
Meaning total capital return to shareholders since the program's inception is now $108.4 million. That includes cash dividends plus repurchases of shares, warrants, and convertible notes.
They are executing a highly disciplined playbook, squeezing massive margins out of current tight supply, paying out consistent dividends, and hedging their future eco-fleet.
It really is a masterclass in cycle management.
And it leaves you with a really provocative thought to ponder. Will Seanergy's aggressive move to buy up these scarce 2029 shipyard slots set off a panic among competing dry bulk operators?
Oh, like a scramble for whatever capacity is left.
Exactly. If competitors realize they're locked out of fleet renewal until the 2030s, it could fundamentally alter market behavior. It could potentially squeeze asset prices and charter rates even higher, just as those new environmental regulations force older ships out of the fleet.
Make sure to follow the show for your daily earnings coverage.